All right, let's talk about one of the most brutal truths in all of finance. Why do so many people who try to trade the markets end up losing money? We're going to get right into it.
Let's just start with this number and let it sink in for a second. 90%. You look at study after study and they all pretty much land right here. This is the rough failure rate for new traders. And that's not an opinion. It's just a statistical reality. So the big question is, why?
You'll often hear this captured in what's called the 90-90-90 rule. Now, it's more of a saying than a hard and fast law, but the data really does back up the spirit of it. In fact, some studies show that a full 80% of all day traders quit within just 2 years. It tells you right away that the first goal in this game isn't even to get rich, it's just to survive.
So here's how we're going to break this down. First, we'll look at that harsh reality. Then we'll talk about the two big enemies every trader has to face, the one inside your own head and the structure of the game itself. Then we'll walk through what a classic losing trade actually looks like, and finally, we'll get to the good part, what the successful few do differently.
Okay, Section 1, the harsh reality. We're talking about academic studies that have analyzed millions upon millions of trades, and they are crystal clear. The vast majority of individual day traders lose money. One of the big ones found that 80% of them are gone within 2 years. And the number of people who can predictably turn a profit after costs, it's tiny, way less than 1%.
So that leads us right into Section 2 and the first major battleground, your own brain. You gotta understand, the challenge of trading is like fighting a war on two fronts. And honestly, the most dangerous one is the one that's happening right between your ears. Our own psychological biases are almost perfectly designed to get us to make terrible financial decisions.
It all starts with overconfidence. This is that little voice that tells you your information is better than everyone else's, that your skill is sharper. And this isn't just some abstract theory. There was a huge study that looked at 10,000 brokerage accounts, and what they found was wild. The more people traded, the worse they did. The researchers basically said these people were paying fees just for the privilege of losing money.
And then you've got this one, regret aversion. It's that deep, gut-level human need to not feel the pain of being wrong. In trading, that is absolutely fatal. It's what makes us hold on to a losing stock, just praying it'll come back so we don't have to actually admit we screwed up. And the research shows traders are about 1.5 to 2 times more likely to sell a winning trade too soon, but hold a losing one way, way too long.
And you don't have to read a textbook to get this. A trader on Reddit just nailed it, cutting right through all the jargon. At the end of the day, it's not about complex charts. It's about the simple, incredibly painful act of saying, I was wrong. That is the psychological battle of regret aversion in a nutshell.
And finally, there's this combo, limited attention and trend chasing. Think about it. There are thousands of stocks out there. You can't possibly analyze them all. So what do? We focus on what's loud, what the news is yelling about. And that leads directly to chasing trends. One study found that nearly 40% of all new money going into mutual funds went to the top performers from the previous year. That's literally the definition of trying to drive by staring into the rearview mirror.
Okay, now for Section 3. Let's say somehow you conquer all those biases in your own mind. You still have to face the enemy without, the actual structure of the game itself, which frankly is stacked against the little guy right from the get-go. You're not just playing against other folks like you. You're up against billion-dollar hedge funds with their armies of PhDs and lightning-fast computer algorithms.
And here's the core difference you have to understand. Long-term investing, generally speaking, is a positive-sum game. As companies innovate and economies grow, the whole pie gets bigger, so lots of people can win together. But day trading, that's a zero-sum game. No new value is created. Think of it like a poker game. For you to win $1, someone else at the table has to lose that exact dollar.
But you know what? It's actually worse than that. Once you factor in all the commissions, the fees, the taxes, day trading becomes a negative-sum game. So back to that poker game analogy, this is like the house rake. The casino takes a small cut of every single pot, so the total amount of money on the table is always shrinking. You don't just have to beat the other players, many of whom are the best in the world. You have to beat them by enough to also cover the constant cost of just being in the game.
So what is the real-world cost of playing this negative-sum game? Well, the data is just staggering. That landmark study by Barber and Odeen found that the most active traders underperformed the general market by a whopping 6.5% per year. To put that in perspective, if you have a $100,000 account, that's like starting the year in a $6,500 hole that you have to dig out of before you can even think about making a profit. The very act of trying so hard to win was precisely what was causing them to lose. So, you have the enemy within your brain and the enemy without the game. The real killer is how they team up against you. In this next section, we're going to build the anatomy of a typical losing trade and see how this toxic combination creates a totally predictable cycle of failure.
So here's how it usually plays out. First, you've got the trigger. A hot stock is everywhere, it's all over the news, and it grabs your limited attention. Next, the entry. You jump in, maybe putting in way too much money because your overconfidence is telling you this is a sure thing. Then comes the mistake. The trade immediately goes against you, but regret aversion kicks in hard. You can't stand the idea of taking that small loss. That leads to the spiral, where you might even add more money to your losing position, doubling down and just hoping it'll come back. And the result? A small, manageable mistake snowballs into a huge portfolio-crushing loss.
Now, I know this all sounds incredibly bleak, but there is a way forward. And that brings us to our last section, what the successful 1% do differently. And, spoiler alert, it has nothing to do with a secret indicator or magic formula. It's about systematically reversing every single one of those bad habits we just talked about.
This table really says it all, doesn't it? Losers table really says it all. Losing traders bend and break their rules just to avoid taking a loss. Winning traders stick to their rules, no matter what. Losers add more money to bad trades. Winners cut their losers fast. Losers get scared and take tiny little profits, while winners have the conviction to let their good trades run. Bottom line, losers operate on hope. Winners operate on a plan.
When you really look at the core habits of that top 1%, they're almost boringly simple. It's business-like. They always put risk management first. They trade their plan, not their fear or their greed. They know that less is more. They wait for the absolute best opportunities instead of just clicking buttons all day. And they are relentless about reviewing their own performance, figuring out where they went wrong, and getting better.
Which really leaves us with this one final critical question. All the evidence suggests that for most people, trying to beat the market with constant trading is a losing game. The real game, the one that the winners actually focus on, is the internal one. It's not about being smarter than the market, it's about conquering those predictable, irrational voices inside your own head. The real challenge isn't beating the game, it's mastering yourself.